Welcome back to the Frank Roche Show. This is Frank. A hot take on the Federal Reserve's actions today. Today, December 13th, finished a two-day FOMC meeting, the Federal Open Market Committee meeting from the Federal Reserve in Washington, D.C. Their interest rate policy decision group, they decided to leave the federal funds rate unchanged at 5.5%. It's clear now, I've mentioned this before, there's no denying now, the Fed's primary mandate is plunge protection of the stock market. I don't care what anyone says anymore. Their legal mandate is full employment and stable prices, but their real mandate is to protect pension funds, 401k, hedge funds, the banking system, and blatantly work to widen the income gap across America, blatantly work to favor those who own stocks against those who don't. Inflation, consumer price index, still running at 4% ex food and energy. Producer price index running at 3%. The Fed's target for inflation is 2%. We remain well above the Fed's target. Unemployment is below the natural rate of unemployment. Gross domestic product is at potential, if these numbers are real, mind you, unless the Fed knows something I don't. And the Fed left interest rates unchanged today. They should have increased rates another 25 basis points. Now, they're signaling in some of their commentary in their dot plot diagram that they might be cutting rates in 2024. What we need now is for the U.S. Congress to change the legal mandate of the Federal Reserve to drop full employment and to only require them to maintain stable prices and a healthy banking system. Because what they did today was another giveaway to the stock market. The language that got stocks moving is job gains have moderated, a strong pace in the third quarter, inflation has eased over the past year, and here's the key part. In determining the extent of any, the word any is new from their last statement, additional policy firming may be appropriate to return inflation to 2% over time. That word any now implies that they could lower rates instead of increase rates. Stunning. The Federal Reserve is setting us up for more inflationary peril in the future, for consumers and businesses to ingrain high levels of inflation in their expectations. Really, really bad move. A giveaway to the stock market. The S&P 500, just before 2 p.m., trading at 4,647. Blasted off to a high at 4,708 after the statement was released, closed the day at 4,706, new record highs. The U.S. 10-year Treasury bond, the benchmark, before the meeting, just before 2 o'clock, yield 4.17%. Closed the day at 4.02%. The 10-year should be above 5%. Dollar against the euro as a proxy. Dollar trading 107.84 just minutes before the 2 p.m. release of the statement. After the statement rallied up to 108.95 against the euro, closed the day at 108.74 against the euro. And then lastly, commodities largely unchanged, but they got a little blip up after 2 o'clock as well on pure speculation. I would say for the U.S. economy, for consumers, for real incomes, for real wages, the Fed just said, screw you. Remarkable that now the market is pricing in rate cuts in 2024. I think the Fed really messed up today. They are going to ingrain high levels of expectations for inflation into the economy. That's my hot take. I'm Frank. Always try to buy American.